Good afternoon and welcome to the EKF Diagnostics Holdings PLC full year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Julian Baines, Executive Chair. Good afternoon to you, sir.
Good afternoon, everyone. Thanks for joining the call this afternoon. Accompanying me today, I brought along Gavin Jones. Gavin is the head of our senior management team and looks after all the product management, all the new products, product updates, and is an integral part of the management team. I thought it would be quite good this roadshow to introduce further members of the staff so that investors could get used to new members of the team that have been with the company for a long time that really do drive the business. And as usual, Steve Young's with me, FD, to answer any financial questions. Before I kick off with the presentation, there's a few things I would like to say. We've worked very hard over the past year to turn the ship around on EKF and look at delivering just high margin, high profit products. And looking at what we've achieved, we've increased our margins to 48% in Q4. I know the presentation says 45%, but we've managed now to get it up to 48%. We've knocked 3.5 million off the overheads. We're generating around 500,000 to 600,000 pounds a month in cash now, which we're aiming to get up towards £1 million. We have a tax rebate coming from the United States for $2.7 million, 2.2-ish million pounds. So we would hope to be around 10 million cash at the end of this year. And what you'll hear from my presentation today is EKF simplified down to the core products with the highest margin and the highest revenue opportunities, because the focus for me now that we have implemented all these changes is actually to drive growth, drive margin, drive EBITDA, keep the cost base at a sensible level, and then on top of that, manage the growth within South Bend, which will give the large growth opportunity within the business. So by doing this, we feel that we've got a very straightforward presentation today and something that hopefully will encourage questions, but also help in understanding exactly where EKF is headed and what we're trying to do. So on the first slide, we have the financial highlights. Revenues were 52.6 million. Gross profit before exceptionals 24.4. As I said, gross margin for the year was 45%, but it's now at Q4 was at 48%. Our aim and Steve's target is to get gross margin to around 52% this year. We've reduced our overheads by 3.5 million. Annualized this year, I expect that to be around 4 million, again, increase in margin. Adjusted EBITDA of 10.4 million, which if you think that we did 4.7 million in the first half of 2023 and 5.7 million in the second half, it shows you that the margins are improving at an ever accelerated rate, leading to strong cash generation. We returned a profit, 2.1 million, and cash generated from operations of 8.8 million. But as a reminder, we are now generating 500,000 to 600,000. Our capital expenditure and cash outflows have reduced significantly. So we are in a really strong position. We've turned the ship around, but now we've got to make sure it goes forward. And all I'm focused on, all I care about is driving growth within the business. So the operational highlights, we continued very sustainable growth in our core business lines. However, a few years ago, our point of care growth was around 6%. We're seeing a significant growth in key and core products within the point of care portfolio. So diabetes grew by double digit, and in point of care, double digit is the what you aim for. However, Quo Test grew by 19% year on year, showing that we really are penetrating certainly Western Europe and APAC markets and you'll see later on the geographical spread of this business, showing that we're a truly global point of care business. Hematology delivered 10% year-on-year growth, but DiaSpect TM delivered a 34% growth, which is way beyond anyone's expectations, and it's continuing into 2024 to deliver that level of growth. The reasons being are a little bit unfortunate in a way. We are seeing big growth in Europe, Middle East, and Africa, and there's a large tie-in between hemoglobin testing and malnutrition in children, testing in poorer countries and war-torn countries. And we do have the ultimate product in the DiaSpect TM and the low-cost analyzer and the low-cost test. We've recently won a tender in Egypt for around £2 million a year of DiaSpect TM, and that's running till 2030. So we are seeing a very strong growth in the most important products within our point of care portfolio. BHB liquid colour grew by 4%, slightly disappointing, but the reason behind the 4% growth is that we've changed our EKF labeled product with Fisher to a Fisher white label product, and the changeover has been quite difficult because we have to work with Fisher to change all their customers from the EKF product to the Fisher white label product, and that has taken longer than expected. But we're now employing a lot of resource, and we're seeing the benefits of changing over to Fisher. The reasons to do this is that, like Cardinal, Fisher have signed an exclusivity with us, which means that they will not sell any competitive products in this market, and BHB is our most important product in the whole of EKF. We've opened the new life sciences facility in October. I'm sure everyone on this call will be interested to hear how that is going and what the next 1 to 2 years is looking like, which I'll go into detail later in the presentation. Finally, we made a decision to get rid of low margin products from point of care. So clinical chemistry will be gone by the end of this year, we hope. We can't just do it straight away because under diagnostics you have to regulations, you have to make sure that your distributors have alternative products, but that product will be declining over the next year. It stood for about 2.1 million revenue last year, but it's loss making, and so we should see our EBITDA increase by actually discontinuing that product. StatSide MBHB is a handheld meter and strip. The meter had been discontinued from 21. We decided at the end of September to stop the strips, and we've replaced it with a StatSide whole blood meter, which is beginning to grow in the US market, and I'll come on to it later. The other thing that investors have to be aware of is obviously we still sell products into Russia. Sanctions mean that we can no longer sell Biosend there. We can sell the tests, but we can't sell the instruments. So in terms of the company, Russia is obviously something that we focus on greatly. In that, we're looking at revenues forecast this year of 54 million plus, but our EBITDA will not change. If not, it potentially will grow from the figures that are in the market. So the geographic highlights, this shows to me that this is a truly global business. So 48.4% of our revenues were in the Americas, and that is mainly driven by BHB and some DiaSpect, some HemaControl, but the vast majority of the American revenues are in BHB. Europe, Middle East, and Africa has now grown 25% over the last few years to be in 41.2% of our overall revenue. That is all point of care, and mainly the diabetes and hemoglobin core products of Quotest, DiaSpect, and HemaControl. And then 10.4% in Asia Pacific. That also grew 16%. So years ago, we were US reliant. I'm a lot more comfortable being reliant on the globe, as in each market is growing at a decent rate. We expect to see the US point of care business grow significantly this year, but I will come on to that later in the presentation. So something that we've gone back to basics again as a business, because we're a razor blade business, and if we don't sell the razors, the razor blades won't come along. And one thing that I've always had historically is that with EKF, when I get up on the 2nd of January, because of the point of care business, we can guarantee 35 to 40 million in revenue before we start the year. And that is a fantastically positive place to be. And as you can see from here, that we sold 9,000 plus instruments into hematology, DiaSpect TM being the biggest one of those. And that's continuing to grow at a rate. We also sold 1,300 diabetes products. The difference being, if you take the DiaSpect TM, it's a product that is about 100 to 200 euros for the instrument. The Quo test is about 1,200 euros for the instrument. So you are never going to do like for like because of the markets that you sell these products in. Also, we continue, although it won't be a major focus of ours, we will continue to sell Lactate Scout, which is fundamentally sold into the sports market for high performance sports. But without that, you wouldn't have the tests. And this figure for me is, and this slide is really important. We sold over and manufactured over 95 million tests last year. But if you look at the slide, 77 million of those were in Europe, Middle East, and Africa. A lot of that being hemoglobin, showing you that the markets in, unfortunately, the poorer territories is where hemoglobin testing is most required. And we have the product for that market, both from a quality and cost perspective. Disappointingly, not everything is perfect. We only did 11 million in the US, but one of those problems was our partnership with McKesson. McKesson decided to change the instructions for use leaflet within the McKesson product, and that took them 7 months to change it, which meant that we didn't sell many products for 7 months. That is now back online. Also, Diagnostica Peruana in Peru is placing large orders with us at the moment for hemocontrol. So we should certainly, I'll be very, very disappointed if we don't do a lot more than 11 million tests in the United States and the Americas next year. And we did 7 million in Asia Pacific, a lot to do with DiaSpect again. So again, the global view, but you can see in point of care, EMA is now becoming the dominant player for us. And that's exactly where you would, with the product portfolio we have, that's exactly where you want to see the large growth in the business. The next one, thank you. So I'm going back to very much basics in this presentation. There's 4 key products in 2 areas, point of care and life sciences. Point of care, I don't think it hurts to remind everyone that we are the number 2 player in hemoglobin testing globally. We work with a global distribution base. The red product and the blue product in the picture is what we sell. The blue one is the DiaSpect, huge growth rate with that product and doing really, really well. Hemocontrol, we sell into WIC programs. We sell a lot into Peru. We certainly sell a lot into Western Europe, Germany. It's more of a doctor's office product, whereas the other one is a field product. And then the 2 white products, the flat one is Quo Lab and the tall one is Quo Test, which we sell into the diabetes market. And then there is a 5th product, Biosen, which I'll talk about later. But we're very focused now on just growth. All I really care about now is growing this business and making sure that we deliver cash, EBITDA, and growth to shareholders. So we had a 3.5% growth, strong sustainable growth in 2023. But we imagine if we're focused on these core products, that will be a lot higher. As you can see in the next point, 34% was achieved with DiaSpect TM, and as a reminder, 19% with DiaSpect. So that is where our focus is going to be. Our consumable growth, which is what you want to see, was double digit. That's quite rare. We saw a 10% growth in consumables. And so we are now very much back on the trajectory with point of care. So hematology, you'll see here that there's 3 products at the bottom, and this is actually another growth opportunity for us, because hematology looks like it grew 2% year on year. Well, it doesn't look like it did grow 2% year on year, but DiaSpec TM grew by 34%. Hemacontrol declined by 5%. But the reasons for that are that in the US, I've mentioned it earlier, one of the biggest selling territories in the US for us is into women, infants and children programs, WIC programs, which is mainly for low-income families, immigration, etc., where they do testing in these programs. They've only just reopened in the last year or so, and we're already starting to see growth into those territories. The second one is Diagnostica Peruana, which is now very much back online. The third area there, Hematostat, that's brought the overall percentages down in hematology, but the reason being is that last year, well, towards the end of 2022, we had a significant problem with the tooling. It's one of the very few products we don't manufacture in-house. The tool basically wore out, and we had huge backorder situation. Our 2 major customers or distributors in the US took a whole load of stock on board at the end of 2022. And whilst we fixed the tooling problem in 2023, we saw a big decline in Hematostat. But now that the stocking is all being cleared out, we are seeing and we've sorted the tool problem out, we're now seeing a large growth in Hematostat in 2024. I'd be very surprised to see overall growth just 2% in all of that. But in terms of revenues, DiaSpec and Hemacontrol are the major players in this anyway, so the revenue difference is quite marked. In diabetes, Quotest grew by 19%, really selling very, very well into APAC, Asia Pacific, certainly in the Philippines. We're seeing a large pull through. We also see a fair amount of growth in the Middle East. So we are seeing a great performance of Quotest. Quolab didn't grow as much this year, and we are looking to phase out Quolab over the next 2 to 3 years. It won't be an overnight situation, but we feel that Quotest is such a much better product. Quolab needs a lot of investment in automation, a lot of investment in R&D, and we feel that that money will be far better spent in Quotest, bringing down cost per instrument, cost per test. So that's where our focus will be, decision made over the next couple of years. Biosen is showing a 5% negative growth, but the major reason for that is we sell, as I mentioned at the top of this call, we sell a lot of Biosen into Russia. And actually from an exchange rate perspective, the ruble collapsed as well. We would have seen a slight growth in Biosen. However, we're not sitting on our laurels and just saying, oh dear, we can't sell it into Russia anymore. We have developed as a company an upgraded Biosen, which will be launched in May. That will be launched into Western Europe, into countries that are utilizing Biosens at the moment. There'll be a replacement program because some of these Biosen devices have been on the market for 15 plus years. We've got better connectivity, better screen, better readout. And so we're looking forward to launching that in May. So I'm hoping that we can counteract the Russian negativity with positive sales in the rest of the world with Biosen. So that is the strategy for the Biosen device. So moving on to life sciences, I don't feel it hurts to say that our major product in the company is beta hydroxybutyrate, BHB. We sell this directly to monitor patients suffering from ketoacidosis, as well as people have to be tested when they come into A&E in the US in case they've got ketoacidosis instead of hyperglycemia. This product is key to us. We are investing quite a lot in improving the product, working in R&D to make sure that we keep the product ahead of the competition. Competition is incredibly limited. It is hard market to enter, and our relationships with Cardinal and Fisher protect us a lot within the United States. Fermentation, as is well documented by now, we have a large new fermentation facility in South Bend. Our old fermentation facility in Elkhart is being run down, and we are manufacturing in the new site in South Bend. The good news with this site is that everyone is waiting to see, is it going to start to work? Well, we did one fermentation in December, and by the end of Q1, we'll have done 3 fermentations for one customer, which will be around $500,000 of revenue. But the thing that's become very clear to me is that everyone has been going, what's your portfolio like? How are you going to grow your portfolio? The customers we have in place and coming through, the one customer that we've done these 3 runs for this year, if we're successful in developing this fermentation process for them and we're able to do the scale up, they will take up 50% of the capacity of this site by next year. The second customer could do the same. But I want investors to understand that this site begins with an R&D process. So you do an R&D trial by error process with the customer. You work alongside the customer, because doing 50-litre benchtop work is very different to doing 3,000 and 10,000-litre fermentation runs. So it'll take 3 to 4 runs before you get the yield that the customer will require. So it isn't, as people may have thought, just a plug and play and you just ferment. It does not work like that. But all the runs you do, you get paid for, because the customer is fully aware that there's an R&D process. But when you get it into scale up at 10,000 litre, then they're pretty much locked in as a customer, and then it becomes a repeat business. My hope is that we'll have 2 to 3 major customers on board and doing the fermentations by the end of this year. And I would also, as I put in my statement, would hope to see the site at capacity in early 2026. It's completely feasible with the customers we have on board and we're doing fermentations for, as well as the 2 to 3 customers we've got lined up. What we won't be doing is, we could not cope with 50 customers. It doesn't work that way. In addition, we're bringing in all our products that we currently make in Elkhart into South Bend. That's about 3 million in terms of enzyme production we do for Roche, Sekisui, Qiagen. So overall, I would hope by 2026, our revenues within life sciences, within fermentation, will be around 12 to 15 million at a margin of above 60%, a huge growth opportunity for EKF and something we're focused on. So life sciences since 2019 has grown by 18%. Manufacturing has skewed figures from Q1 2022, which is why that graph looks so weird, because we had a manufacturing growth in the first quarter of 22 for obvious reasons. We've seen a 4% growth, which I've already explained about BHB, but we have a 60% growth opportunity with the new fermentation site, which we're looking to drive very hard over the next 2 years. BHB, this slide is quite explanatory, because I think it's important that the reason we stopped selling SatSite MBHB, which was coming to the end of its life, you can see the revenues dropped hugely from 2019 to 23. We really needed a replacement product for that. We've launched StatSite Whole Blood, an FDA approved whole blood test for BHB. As you can see, it's already growing and heading towards where we were in 23 with StatSite BHB. It's never going to be as important as the bar chart on the right, which is our liquid color that we sell into hospitals, but it is an important supportive product to the liquid color. So we're very pleased with the performance, that it's growing at 52%, although admittedly from a low base, but we're seeing growth every month from that. The next slide, BHB, all I can say is that the 2% growth, but there's been a 31% negative growth in StatSite M for obvious reasons. We discontinued it from the end of Q4. So fermentation, I fundamentally talked about fermentation during this call. Gavin, myself, and Olga, who's our Chief Operating Officer, hopefully you will meet Olga in the near future. Olga has a fermentation background. She's a really strong operating officer. She does live in Berlin, but she's spending an awful lot of time in South Bend we are really putting a lot of effort and time into turning that business into what everyone expects it to be. The one big thing for me is that we've all learned a huge amount, and you can tell that my explanations these days are a lot different. But I still believe, and we're targeting to have almost full payback within 2 to 2.5 years on that investment. Our hope would be, and this is just a hope at the moment because we've got such a long way to go, is that we do fill that site, and late 2025 we're starting to look at maybe a second site in the area, but that is something that we're aiming for. That's a strategy of ours, but at the moment we've got to focus on growing this business. And so the outlook, I hope you'll agree, is simplification. The 4 products at the bottom of that slide are really key to us. The growth of DiaSpec TM is phenomenal. The growth of Quotest has been, for point of care, really, really high. Then obviously we have to carry on marketing and driving BHB liquid colour, and then fermentation, has to deliver. It's up to us. We have to deliver on that. So our outlook is, I've said it all, we're investing in the core products, haematology, diabetes and BHB to drive growth. Growth is what we're focused on now. Strengthening relationships with key global partners. It's sometimes forgotten that we are very close with Fisher, Cardinal, McKesson, Fresenius, and these partners wouldn't be such big partners for us if our product range wasn't exactly in the areas that they want. 2024 will see the completion of the rationalization process. I actually think that's nearly done. That's in there as a point, but we've streamlined as much as we can. We've taken so much cost out of the business. We're generating cash. Our margins are improving all the time. We should end up with 10 million cash by the end of this year, totally back on track to where we should be. So we're well placed to deliver growth and improve returns from the investments we've made, and we will now just be investing and focusing on our core products. And thanks ever so much for listening to this presentation, and hopefully you have some questions.
Perfect. Julian, thank you very much for your presentation. What I'll do is I'll just bring your cameras back up at this point. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions that have been submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received a number of questions throughout today's presentation, and at this point, if I could hand over to Paul from Walbrook to chair the Q&A, that'd be great, and I'll pick up from you at the end, Paul.
Thank you. Gentlemen, we've got some questions that were pre-submitted, so I'll go through those first. And then we have a number of questions that have come through during the meeting. Quite a few of them are on the dividends, so we'll touch on those. But in the first instance, there was a question regarding the new facility at South Bend and whether EKF had benefited from any government grants or state funding or initiatives.
I'm sorry to say, but no. The simple answer to that is no. We didn't benefit from any initiatives on that site.
Thank you.
And any further investment, I think we would be looking to see what would be available.
Okay. From the same similar question, what part of artificial intelligence playing in the development and manufacture of any of your fermentation products? I think it's a similar question to that you were asked at your AGM, so I think the answer is no. But
we don't utilise any AI in the process at the moment. Gav, anything? No.
No, I think it might be something we look at in the future for our point of care range, but certainly not within the fermentation process, not at this time anyway.
Thank you. A question on BHB. Is EKF seeing any demand or inquiries for BHB beyond its use in diagnosing and monitoring of ketosis? For example, as a clinically useful supplement, for example.
So I think this question is potentially around ketogenic diets or that area. It's not an area we have experience in. I'd like to expand because I think it's a very thoughtful question. The answer is no at the moment, but it's something that we haven't really thought about. So it's a question that I think we should go away and think about as a team and come back. But at the moment, we can't see, there is no application at the moment for our current VHB in that arena. But is there a future expansion opportunity there? I don't know.
I mean, you can use VHB as a supplement within that type of, so not just as a testing parameter, but also as a supplement where you take VHB as part of the program. And there's been a number of different reports on this in terms of how good it is and how positive the utility is. I think for us, it would be a bit of a distraction right now in terms of what we're doing at Life Sciences, and we want to focus with our key and core products. In the future, we'd certainly look at it, but I don't think we've had any approaches for that, and we've certainly not gone
That's the first time I've been asked a question of that nature, but it's not to be ignored.
Okay. One of the shareholders commented that your website doesn't portray an image of a company with cutting-edge fermentation facilities and downstream processing. With the website perhaps coming across as somewhat dated, do you have any plans to bring the website up to date and better reflect the dynamic global business?
Sure, yeah. I think the first thing to say is we agree. We agree that the website does need updating. That's why I'm pleased to let investors know that they should see a new website within by the end of Q2 this year, and we've been working on it for quite a while. We will have increased functionality, new look, and something that will present the company in the way in which it should be presented. Certainly from the fermentation point of view, like there's been a big focus on the life sciences part. We know that the current website really doesn't do it justice. There's a whole host of new marketing material and to go along with that, and we will be running a number of campaigns on our life sciences opportunities in the very near future. I think the other thing to say with our new website, it'll be a .com first, so it'll be based on our PLC website, and then we will, but slowly but surely, roll in our German and US sites into having one place you can find us on the internet.
Thank you. We have a few questions in, but I'll tackle the ones on dividends.
Yes,
first was one investor said you failed to mention the dividend being scrapped in the presentation. So okay. I'll just pass on that comment. The questions then I've had, so they're all around the same question really, but I'll ask each one just because they kind of ask it in a slightly different way, so you may want to address them slightly differently. So the first was from Andy. As a stable cash generative business with $2.7 million tax rebate and net cash on the balance sheet, what growth opportunities or issues do you anticipate to warrant the cancellation of the dividend?
Well, if I take a step back from that, we got ourselves into a position last year where the cost overrun in South Bend was so high that our cash positive situation was diminishing at, in my opinion, an alarming rate. So as a board, Chris Rigg and I recommended that we no longer carry on paying the dividend for the foreseeable future so that we can get our cash balances back on track. The other thing is that the investments in the business are really important because we have a number of products that need updating. I mentioned Biosen, but we've got a new lactate product that's a really interesting platform that we want to invest in. We want to update our co-test even more, and connectivity. So there's a lot of money that we wanted to spend on the core business, and everyone, has to remember that. I take responsibility that we overran $7 million in South Bend. So the decision to stop the dividend was done on a business principle, and I strongly back it. It wasn't done for any other reason. And when we start to generate cash again, I still think that investment in the business, I mentioned earlier that if the South Bend facility goes really well, I would rather be investing in a second facility that will give even further growth and even further returns to investors. And the third thing is I do listen, and I went on a roadshow in September, and 95% of our institutional fund managers said, why are you paying a dividend? We've got no income funds in our portfolio, and they would much rather we reinvested the money into the business or, have an opportunity to look at M&A, what it did was seriously limit our opportunity to grow this business. And £5.7 million in dividend payments is a huge chunk out for a company of the size of EKF.
Even with that, one of the investors has asked, given you've got cash generation of, they've suggested 500k to 600k per month, did you consider just reducing the dividend rather than suspending it?
No, we just have to be totally straight. No, we just wanted to suspend it. We wanted to get back on track. I think I hope from this presentation you can see that we've turned the ship, we're back on track, but we've got to drive it forward. And I don't want to be, we had to take out, we didn't use it in the end, but we had to take out a loan facility because of the concerns over the dividend. Our auditors were concerned over the payment of the dividend from a going concern perspective. It caused all sorts of business issues for the company. So no, we didn't consider reducing it. We considered, and our fund managers, our institutional fund managers backed that decision.
There's a question from Tim about if you have a period of significant, now that you have that period of significant investment in life sciences fermentation behind you, could we look forward to a period of higher dividends, share buybacks, and possibly even special dividends if and when the business starts to throw off excess cash?
Too soon to say. Let's see where the cash balance goes. My preference is to invest it in the business. Some people like share buybacks. I'm not overly keen to hurry back to dividends, but if, at the end of the day, if we get to cash balance so high, then, that's what happened the last time. The balance was so high and we were getting pressure from institutions to say, what are you doing with your cash? So I think we've got to get there first and then those decisions will be made.
Again, I realise these questions are kind of repeating the same thing, but there's a follow-on question from Andrew that says, if you state that dividend payments are being paused so that you can focus on enhancing shareholder value through growth, this is a significant change, but what specifically do you think you would intend for that cash that is saved? What would you do with it?
Well, as I mentioned, we have to invest in our product portfolio. We have to invest in BHB. And I think there's a strong chance within 18 months we'll need to invest in another fermentation site. And I think that's a much better way of enhancing shareholder value than just giving the cash back. And I'm not entirely sure. We succumbed to pressure the first time round. This time I really want to see this business grow. And we're also in a position where I don't want to ever be in a position where I have to raise money at stupid discounts. We're cash generative, we've got no debt. And I think that's a really comfortable and positive place to be and allows the management team, including me, not to be worrying about going concerns, cash gen. We can just focus on driving and growing the business, which is why I came back, because I really do believe in this business and I really do believe the opportunities in front of us. But it's taken a full hard 12 months to realign it back to where it should be as a really high functioning global point of care and life science business.
Two comments from Lawrence and from William have said, we don't have a good track record in M&A. Please don't go down that route. Or one question is, are you actually considering making acquisitions?
No, we're not. Right. Sorry, I've just, when the question was opened up about share buybacks, dividends, etc., I'm just trying to express the opportunity of giving ourselves some freedom to make the right decisions and the right investment decisions with the business. M&A, I agree with the recent track record, believe me, I fully understand that. So there's no immediate thought at all of doing M&A. But if the right opportunity did come along that was cash generative and profitable and fitted in within our distribution channels, it would be a real shame not to be able to take advantage of that if we'd given the cash back in a dividend. So, there's nothing in the pipeline. And actually, I'm sure as investors, if you try and find another EKF out there in the market at the moment that hasn't been swallowed up by one of the big boys, it's really difficult. So even if I said I really want to do M&A, there's nothing out there to buy anyway. So it's not an issue.
Moving away from that onto margins. The couple of the questions were, one of the investors thought, did they hear correctly that you think 60% gross margin would be attainable on fermentation? Was that what was said?
Yes.
So we're just looking for you to confirm that. A question from David is margin improvement being driven mainly by price increases or cost reduction?
Cost reduction at the moment. Price increases, we've averaged out at about 5%. We introduced a price increase of around 7% this year, but we hit about 5%. And people say to us, why is that? And that's because some of our major contracts with our big guys are tied in on a pricing structure over a 3 to 5 year period, for example, with Fresenius, Fisher, Cardinal. So some of the bigger revenue drivers we can't actually influence with price. So we averaged around 5% price increase, but the margin growth was that we were really fat in terms of personnel and legacy situation. We had a number of cash scenarios as well that we had to pay, but we had if people remember, we had a debt we had to pay back to Asahi, which is finished. We've closed down the 2 more sites that we have in the UK, will be finished in June. All of this is leading to significant increases in cash generation, and margin is being driven by cuts and continuous product improvement, streamlining the product portfolio, getting rid of clinical chemistry, getting rid of stat site BHB, glycated albumin, all these things. By getting rid of them, we're actually seeing a margin increase because they were negative margin products in our portfolio.
Alex?
So I was going to just add that automation, we're also looking at automation to cope with some of the sort of growth in some of the key products being manufactured at some of the facilities.
Alex asks, could you speak about margin outlook, especially as it relates to the effect that the scale up of fermentation would have on overall margins?
Well, the only way we can look at it is that I've set Steve a target of getting up to around 52% margin this year. If South Bend goes gangbusters, it may get more than that, but point of care margin is around 40 to 45%. Fermentation is around 60 to 70. So if you average it out, I would say 52 to 55% is the gross margin level that I would seek to attain. It would be very difficult to get it higher than that.
Another margin question, but specifically on BHB. Did you have to sacrifice any margins on BHB to get exclusivity?
That's a great question. The answer to that is yes, but the caveat to it is that the South Bend site hasn't just proven to be very useful from a growth opportunity perspective. It's also proven to be very useful that we only have, historically for a BHB, we'd have to do 4 runs a year. Because we've got much larger fermentation capability now, we only have to do 1 run a year and distribute from there, and there are no shelf life issues with that. The same applies to Roche, the same applies to Sekisui. So actually, the margin decline of 12% with Fisher will be at least 50% made up by the fact that we only have to produce once a year. So we did have to do a margin, but we will still see above 70% margins. And the value is so much more valuable to protect our market in the United States and improve manufacturing efficiency than, and so it was worth the sacrifice in every way.
From the same investor, Martin asks, is there a reason why BHB is largely in the US? Sales?
Yeah, well, because the crazy thing is, Martin, so Martin Teller, yeah, hi Martin. The crazy thing is, everywhere else in the world, we're doing okay in Latin America, but all the white papers on BHB were written and produced in Oxford and Cambridge. Yet in the UK, we still test ketoacidosis by smelling the breath of the patient to see if it smells of pear drops. That also applies in Europe. Because only 5% of people with hypoglycemia are actually having ketoacidosis, there's a lackadaisical attitude to BHB in the rest of the world. I don't know if you've got anything to add to that, Gab, but.
Well, I mean, you're not wrong in terms of the way in which BHB is dealt with, but it's also dealt with, certainly within Western Europe, the preference is to go for the handheld meter.
Yeah, the Abbott one, yeah.
Yeah, which is, and those there are devices out there that have been out there for a very long time, very well established. They don't use the clinical chemistry reagent that we utilize in the US. It's just a very different model of how they do it. Where they are using the handheld meters, it is mostly BHB in which they're testing, but on a strict basis.
Thank you. Just going through a few more questions still to go. We've got 15 minutes left. One question: are you still determined not to accept a lowball offer from Harwood?
Oh, that's whoever it is. That's my annual or my 6 monthly question. No, we are not accepting a lowball offer from Harwood. Christopher also doesn't want to take us private. We're staying public. He asked me to come back, whether you like that or not, I'm not sure, but he asked me to come back because he fully believes in this business as a public business, and there is literally no intention to take it private. There is a disappointment, though. One of our fund managers came up today, and this is just an aside, and said, if we floated today as we are, our share price would be double where it is today because of the history. I get why we are. I'm not, I'm not saying that, but that's how you have to look at it. And Christopher sees the opportunity, hopefully, when markets return, that EKF is a very, very strong AIM listed business. There's no need whatsoever to take it private.
There's a question, maybe for Steve, I don't know if you can answer this, but one investor said, how exactly have you cut overhead by 3.5 million? They pointed out that they're down 66% on their investment. Do you have any expectations or targets for OPEX management going forward?
I think sort of the 3.5 million has come down across various areas. The headcount is down from probably 370 roughly at the beginning of 2023 to probably around just over 310 at the end of 23. So some of the savings have come in that area. There's other areas which we need to target moving forward, which we got into some internal targets on intranet, where perhaps some of the costs have increased during the COVID peak then at a rate you would not have expected them to have increased at that level. So faster than the rate of the growth in sales, possibly. So yeah, we do have internal targets which we're looking at to reduce the sort of overhead spend further. We're not looking at any reductions in headcount. So I think I've seen another question was asking about headcount.
I was going to say that's the opposite question.
I think we are where we are. Where we're comfortable with the headcount. There's no plans that should be able that the headcount as it stands at the moment should allow us to reach our targets in 24, 25, unless of course then fermentation goes through the roof, and we then need to probably strengthen the headcount in that sort of area. Yeah.
So that answers Tim's question, which was about headcount and overhead cost. Do you think you're the right size now, and do you have capacity? Should you reach your goals, or would you need to scale up the workforce? So that answers that question. Could you comment on priorities for capital allocation going forward, i.e. shareholder returns, M&A, organic growth, CapEx? And on these latter three, is it in life sciences or point of care? And what's the right level of debt, if any, for the business?
We haven't got, we don't intend to have any debt. CapEx in the next 12 months will be more aligned to point of care, certainly in R&D with lactate, because we've developed a strip that we haven't talked about much, but we have developed a strip with our lactate product we've called it the Response, which actually is a strip that doesn't cross-react with other substances. So what I mean is that historically some strips cross-react with aspirin or paracetamol, etc., etc. We have a strip now that we've developed over a long period of time that doesn't cross-react with anything. But I'm going to hand over to Gavin, because it's also a panel, and to spend some money on driving this. Gavin, being the product manager, is the one who really is driven by this product. So I'll hand over and let Gavin explain it in more detail.
Yeah, and I think this also goes to answer one of the other questions as well, in terms of, I think there's a later question saying, are we actively considering expanding EKF's point of care portfolio? And the answer there is yes, but it has to be the right type of product, and it has to fit within our current product portfolio and our distribution base. We have quite a focused global distribution base. They work in specific areas. We work in specific areas, diabetes and hematology mostly, in point of care. And the device that we're working on at the moment, and the sensor that we're working on, really should be focused in those areas to try and support some of what we're doing, and build upon, you know, the great foundation that we've already made. So yes, we are making good movements there. I think Julian alluded to the fact that this could be a platform product, and I think for us that's a very positive step forward. Most of our devices, not all, but most of our devices are single analyte tests, which has done us well. It's helped serve the right markets, but moving forward, we can certainly improve on where we are by building out this platform device and putting multiple tests into the same sort of areas that we're already selling into. And that's what we really want to achieve. And that's going to take some time to get to market. You know, the regulatory landscape is not quite what it used to be. And that is going to be challenging. You know, IVDR takes a longer time than the previous IVDD, but we understand that. We're very much focused on that, and that's where a lot of the investment is going to be moving forward.
And then, as Steve said, there'll be investment in automation improvement, which will improve margins within the business. So it'll be more point of care driven, but there still will be downstream processing investment in South Bend. There are still things to do there, but then it's not tens of millions, it's hundreds of thousands, etc. So we are continuing to invest in the business.
One comment points out, Julian, obviously you were talking about DiaSpec's 34% growth. So in terms of your M&A record, that's an example of a product that was brought on board via acquisition.
Yeah, it was, yeah.
Actually, the M&A history isn't all bad.
Thank you, yeah.
Some businesses.
When I was a BB, I didn't go far wrong, but the last 5 years, I'll accept the other investors' criticism.
So there's a question on, could you give an update on your competitive landscape and your strategy and investment needs in order to stay relevant and evolve? Well,
the competitive landscape in hemoglobin is hardly ever changed. It's us and HemaQ. There are a few products coming on board with, for example, non-invasive, but they've been around for a long time. They're gaining a little bit of traction, but we're seeing far greater growth with our product portfolio. We certainly do not ignore that area, and it's certainly not causing us any issues at the moment because it has been around for a long time. HemaQ are our major competitor. I think that we are taking a fair amount of market share from them. If you look at our Europe, Middle East and Africa performance, it's been incredible, and that will be to the sacrifice of HemaQ. In diabetes, interestingly, the #1 product in HbA1c for years has been Afinion, when it was owned by Eylea, and Abbott have taken it over, and we see far less of it and far less competition from Afinion. So HbA1c, which is Gavin's area, is a much more driven by Indian and Chinese product than the old school Afinion, Nicocard, etc. I don't know if there's...
Yeah, there's certainly been, I think within HbA1c, there's been a lot of competitors enter the market. Certainly since we entered the market, we've seen quite a few, and that landscape changed quite a lot. It's also been, there's also been quite a change in the quality of product that's out there as well. And that has helped us in some markets where we have been considered to be, a much better manufactured product, German-made product. And that's a positive for us, and I think that's reflected in the numbers that we've seen today. Certainly, if you consider Quotest, it's a pretty old product. It's been around for a long time, and it's still growing. It's still gaining market share, which is good for us. But yeah, HbA1c is changing all the time, and we're trying to change with it, and we want to make sure that we respond to that competition as it comes at us.
Fermentation, the situation is still the same. In our particular area, we do not seem to have much competition in the United States for the small to 14,500 litre fermentation. So that is something that is a positive and pretty satisfactory for us, is that competition in that area. And I think, believe it or not, the opposite is true. There's a dearth of fermentation capability in the States, and competition wouldn't really hurt us anyway. And I hope that we can see that business grow over the next 2 years, as I've talked about a lot today.
We've got a few left. I'll try to get them in the last 5 minutes. But one question was from Martin. Some diagnostic companies have highlighted challenges recently of receiving payments in Egypt. Do you have any risk there with that?
No, we don't. But yes, we had a challenge. There we go, Martin. It's the way we've had to do it has been highly complex, and it's with the Egyptian government, and we're paid in dollars. We'll have to meet up sometime, Martin. I'll go through it, but it's longer than 5 minutes explanation. But we're completely safe and paid up front for the product, but the way the mechanism is highly complex.
In terms of fermentation, enteral nutrition is a very large market. Could EKF's fermentation facility make nutritional products, and are you receiving inquiries for these?
Yeah, we've got, I don't know what happened to the mung bean fermentation. We did have quite a lot of gastro products and fermentation inquiries. We used to do mung bean fermentation. I need to come back. I don't actually know what's happened to that fermentation.
And then about the facilities, a couple of questions addressing the same thing. In terms of your next fermentation facility, what are your thoughts on location if you were to expand? And if you do require a further facility, what are your considerations regarding Elkhart?
We're looking to close Elkhart anyway. It's South Bend that we're looking to grow. We would probably, if we're going to grow the fermentation, because all the capabilities are there, we'd probably do a second site in South Bend and grow it that way.
The question was also, why would you close Elkhart? What would be the reason?
Because it needs a significant amount of investment. It was very run down. One of the reasons for doing South Bend is it's extremely run down. Just as an addition, we would fund the next facility should we be in the great position of needing another facility. We'd fund it a bit differently. We'd probably lease the fermenters. We wouldn't just do it all for cash. That is a lesson learned, that we would certainly fund it in a different way.
Steve, you might not be able to answer this if you don't have it to hand, but could you give an indication about total CapEx spend, including IFRS 16 over 2024-25, not assuming further South Bend expansion? What's the current level of maintenance CapEx for the current EKF structure? If we need to come back, we can give us a bit later. But
we're planning sort of level capital expenditure in terms of roughly 3 million in sterling a year. Because we've got the capital budgets in place for this year from the various businesses and what they've asked for and submitted. So roughly over the next few years, it'll probably be roughly 3 million a year sterling maintenance and sort of automation and improvement projects which we're doing. Yeah.
And then just our last question. Did the board, the issue of splitting chair and chief exec roles debated by the board? And if so, what concessions were reached?
It hasn't particularly been discussed by the board at this moment in time. The reason being is that I was asked to do a job, and I'm still halfway through that job. It hasn't been brought up in recent board meetings, no, about splitting the role again. At the moment, the board, I believe, feel quite happy in the arrangement as it is. Chris Rigg is having significant input as well into the business, and so the board, I believe, feel comfortable, but happy to field that question at the next board meeting.
Thank you. That's the end of the online questions, and I'll hand back to IMC.
Perfect, and thank you very much for answering those questions you can from investors. And of course, the company can review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Julian, could I just ask you for a few closing comments?
Yes. Well, firstly, thanks very much for your questions and listening. And I know that I'm fully aware that the journey hasn't been that easy over the last few years. I hope you agree with our overall strategy and what we're trying to achieve, getting back to the core products. I am genuinely excited about the 4 or 5 products I've talked about at length today, and I think that the opportunity for where EKF is and where it's got back to is really strong. The only issue now is that we've got to deliver for you, and that's down to us. But we have put the business back into a position of potential strong growth, and that's what we all hope to deliver.
Perfect, Julian. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure be greatly valued by the company. On behalf of the management team of EKF Diagnostics Holdings PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.